Hey there, Mike with Financeable, back with another interview question review for you today. If you are interviewing for banking, PE, or hedge funds and find these videos helpful, we've got a lot more coming. Definitely hit the subscribe button down below and let's hop in. So the question today is, how does capital intensity affect valuation? Let's start with, what's capital intensity in the first place? So capital intensity is basically the money we have to pour back into a business as it grows. So a business makes money, and then we have to put in more money to basically keep the business growing in the form of capital expenditures and working capital for most businesses. So that's what we mean when we say capital intensity. And at a very high level, if we have more capital intensity, meaning more reinvestment needed, we'll have lower cash flows and vice versa. So now that we've covered what capital intensity is conceptually, let's talk about it a little bit more mechanically and look at some numbers. So we're going to look at the screen here, and once again, just to clarify, capital intensity is going to be these two items. So this is our capital intensity. And again, what these two line items reflect is reinvestment in the business as the business grows. And what we have here are two scenarios. One where we have low capital intensity. Let's imagine it's a business that outsources all their manufacturing. And then another business that has high capital intensity. Let's say that that business manufactures all of its products. Let's look at how that affects the numbers for our example. All right, let's start on the left-hand side here and look at our low capital intensity business. And again, we're imagining this is a business that outsources its manufacturing, so it has lower reinvestment or capital expenditure requirements. So we're going to assume that this business has $10 of capital expenditures each year that are needed. And we'll also assume that the business needs to invest in working capital as it grows. And let's make that number 5. So it's going to be -5 of working capital. And so now we have a business that has $100 of profit, less 20 of taxes. So that's going to get us to 80. We're going to add back depreciation and amortization. That gets us to 90 after those items. And then we're going to deduct 15 between capital expenditures and changes in working capital. So in the end, we'll have $75 of unlevered free cash flow. So let's plug that in here. Now let's look at the example on the right-hand side, the high capital intensity example. And again, we're assuming that this is a company that does its own manufacturing, that manufactures all of its products. So for this example, we're going to assume a higher level of capital expenditures, let's say $20 of capital expenditures. And let's say that for one reason or another, it actually has higher working capital requirements, maybe due to its business operating model or something along those lines. So we're going to have $10 of reinvestment related to working capital. So in the second example, what we have here is $30 of outflows, or capital intensity, so to speak, versus 15 that we had before. So in the second example, we're only going to have $60 of cash flow. Now that we've calculated cash flows for each of these examples, let's talk about how the cash flows in each scenario would affect our valuation. So in short, with the DCF, what we would do is we project these cash flows out into the future for both scenarios, and we'd bring all the cash flows back to today, and that would give us our enterprise value. For the sake of this example, let's assume that the cash flows are the same this year and for every year out into the future. Then we would discount our cash flows back to today using our weighted average cost of capital, or WACC, which would give us, when we pull those cash flows back, the enterprise value for both of these businesses. Now, we're going to hold WACC constant for both of these businesses. So we're going to assume that they have the same WACC. And in that case, if you have, all else equal, if you have a higher set of cash flows that are consistent out into the future, and you discount them back at the same WACC, you're going to have a higher EV, or enterprise value, versus if we, again, have the same WACC and we have lower cash flows, we'll have a lower enterprise value. And it's really as simple as that. So the short answer here is, if I have lower capital intensity, all else equal, my valuation will be higher. I'll have a higher valuation. Now, there's a catch there, which is there's a lot of real-life nuance that can go into this. So for example, if that outsourcing creates higher cash flows, but I maybe have a less stable business because I don't control my manufacturing, perhaps my WACC would actually go up and that would change the entire answer. But at a very simple level, if I have lower capital intensity, I'm going to have higher cash flows and thus a higher valuation. So that's actually how you'd answer this in an interview. If I have two businesses and one has lower capital intensity and the other one has higher capital intensity, again, all else equal, I'm going to have a higher valuation for the business that has lower capital intensity. So hopefully the answer to this question is a little bit more clear now. We have a lot more of these videos coming up, so hit the subscribe button down below and hope to see you soon.